There was a young man who had no money but learned to trade at the age of 15. He became the world's richest man as soon as he began trading. However, over time, the richest man lost all of his wealth and committed suicide. Don't you think it's an amazing story? It was none other than Jesse Livermore who spoke. Yes, you read that right. Basically, staking anything on a possibility or risking money on something with a potentially bad consequence is what is meant by gambling. Gambling, however, assumes a far more complex dynamic than the description suggests when trading is taken into account. Many traders trade in a style or for a motive that is utterly at odds with being successful in the markets, and do so without even realizing it. We will examine the covered ways that gambling infiltrates trading activities, as well as the potential catalysts that lead someone to start trading in the first place. If it turns out that they are in fact acting on gambling urges, it is highly likely that somebody who believes they don't have gambling tendencies will not readily acknowledge to having them. However, understanding the driving forces behind our behavior can influence how we choose to act going forward. Even a student who gets a pocket money of $500 tries to get more money and start trading for his expenses. And common people like us try to earn money even though they have a decent job as an active income. One tendency can be seen in many people before trading ever takes place, and this same motivation continues to have an impact on traders as they gain expertise and become regular market participants. Even though some individuals may not have any interest in trading or investing in the financial markets, social pressure forces them to do so. This occurs frequently, but especially when a lot of individuals are discussing market investing. People experience pressure to conform to their social circle. They invest as a result to avoid offending, disregarding, or making others feel excluded. If people truly know what they are doing, making some trades to please social pressures is not gambling in and of itself. But gambling is engaging in a financial transaction without having a firm grasp of investments. Such people lack the knowledge necessary to influence how profitable their decisions will be. The market has a lot of moving parts, and disinformation among traders or investors makes everything feel like a game of chance. In the absence of knowledge that enables people to overcome the odds of losing, every transaction is a form of gambling. How a person approaches the market will determine whether they become a successful trader or remain an ongoing gambler in the financial markets. Once someone is involved in the financial markets, there is a learning curve, which based on the social proofing discussion above may seem like it is gambling. But this may or may not be true based on the individual. Trading the markets is exciting. It connects the person to a global network of traders and investors with different ideas, backgrounds, and beliefs. However, getting caught up in the idea of trading, the excitement or emotional highs and lows, is likely to detract from acting in a systematic and methodical way. When a person trades for excitement or social proofing reasons, it is likely that they are trading in a gambling style rather than in a methodical and tested way. In any odds-based situation, trading in a scientific and systematic manner is crucial. The most obvious motive for trading would seem to be to gain profits. Why trade if you can't win after all? However, there is a secretly harmful weakness in this belief in trading. Trading to win might actually push us further away from the main goal of making money, even though that is the desired outcome overall. For instance, Taylor purchases an oversold stock. Taylor is in a bad position as the stock keeps declining. Taylor keeps holding, hoping the stock will recover so they can make a profit, or at the very least break even on the deal, rather than realizing the stock is not just oversold and something else must be happening. The trader is forced to stay in losing positions because exiting them would mean admitting defeat due to the obsession on winning. Good traders lose a lot, but they also acknowledge their errors and minimize the harm. They can be lucrative across a large number of trades since they don't have to win every one of them, and they can take losses when the situation calls for it. When a trader maintains losing positions after the initial entry conditions have altered or become negative, they are no longer following basic trading principles and are instead engaging in gambling. And you know what? Putting money into an asset, such as a stock, with the hope of making money from it is called investing. Contrarily, gambling involves risking money on a result that is uncertain but statistically likely to be unfavorable. While an investor owns a share of the underlying company, a gambler owns nothing. Now, you must have the biggest question in your mind that, is investing better than gambling? While both require reducing risk in order to maximize profit, an investor typically has better odds than a gambler. This is so that the casino may benefit from its statistical advantage over the player, which increases the longer the player plays. Although a gambler still has a chance to win big, it is more likely that they will ultimately lose. Although investing might result in significant losses, the stock market often rises over time, and if you stick with it, your chances are generally better than those of a gambler. Gambling is psychological and similar to playing the lottery, where you are willing to lose a small sum of money in hopes of winning a huge sum. You can forecast or specify your rate of return range when trading. Gamblers not only trade with their aspirations as a guide, but also with a dangerous lack of market research and risk management. Their main objective is trading, not studying charts or keeping an eye on danger. The secret to success in diversification is to keep an eye on trends, follow them, and act promptly. Although trading is a long-term endeavor, many people are drawn to its thrills in the short term. They get the necessary dopamine boost from a successful deal, whereas a lost trade causes intense suffering. Consistency, restraint, and emotional stability are traits of a successful trader. Trading in the stock market is quite unpredictable and dependent on a variety of variables, making predictions very challenging. In a game of gambling, one poor decision can destroy your financial security, emotional stability, and occasionally even your relationships. Some traders act impulsively, taking positions without giving them any thought. Purchase 100 far off. The end of the world is coming, and gold calls. Wait till they lose value after 3 months. Pay the account back. Repeat. Those sorts of things. Other people frequently commit the same errors. Take a risk by taking a large risk. Gain too little. Repeat. Some people handle it like a business, either as a second source of income or their main source of revenue. They have a clear strategy. Play just the markets that meet the strategy, manage risk, and manage profits. Although they continue to gamble, they do so in a professional and business-like manner. One reason why day trading could become addictive is because it involves a lot of short-term thinking. As a trader tries to make quick decisions based on limited information, his or her focus narrows significantly. The same thing that makes gambling attractive also makes day trading interesting: the potential for financial gain. With the availability of online trading apps, it is all too simple for consumers to continue trading while they are at work, out with friends, or relaxing at home. Gambling tendencies go much beyond the conventional criteria and are much more frequent than most people originally realize. Gambling can take the form of feeling the need to prove oneself to others or acting in a way to fit in, which leads to engaging in activity one understands little about. People who gamble primarily for the emotional high they experience from the thrill and bustle of the markets are frequently easy to spot. Last but not least, trading with emotion, or a must-win mentality rather than following a logical and tried-and-true strategy, shows that the trader is making predictions in the markets and is unlikely to succeed over the course of many trades. This wraps today's video. I hope you enjoyed watching it. If you found it informative, please like and share this video with your family and friends. Don't forget to subscribe to the channel and press the bell icon to stay updated. Goodbye, and I'll see you in the future video.